The market has not changed, only the faces in the crowd have. Prices still rise through accumulation, fall through distribution, and punish those who chase movement without understanding motive. What worked for the composite operator a century ago works today because human behavior is unchanged. Example: when price advances on narrowing spreads and weak volume, the trained eye sees distribution while the public sees opportunity. In the study of the stock market, no principle is more fundamental yet more widely ignored than the law of cause and effect. The public is inclined to believe that price movement is spontaneous, that advance and declines occur because of news, rumors, or sudden changes in opinion. This belief is not only false, it is costly. Price is the result, not the origin. Every important movement in the market is prepared in advance, deliberately and methodically, by those interests possessing sufficient capital and patience to operate on a large scale. Before a stock can advance materially, a cause must be built. This cause is formed through accumulation, a period during which the composite operator absorbs supply from weak or discouraged holders without materially advancing the price. This process requires time. Shares cannot be acquired in size without attracting attention unless price is held within a range. To the uninformed observer, this phase appears dull, uninteresting, and unprofitable. To the trained student of the tape, it is the most valuable period of all. During accumulation, price fluctuations become narrow, reactions are shallow, and volume contracts on declines while expanding subtly on rallies. These are not coincidences, they are evidence of control. The composite operator is not seeking excitement, he is seeking inventory. When the available supply has been sufficiently absorbed, resistance diminishes. Only then does markup begin. The subsequent advance is not a surprise, it is the inevitable effect of the cause already built. The same law operates in reverse. Before a significant decline can occur, distribution must take place. Here the public is most easily deceived. Price is often advancing, news is favorable, and optimism is widespread. Yet beneath this appearance of strength, demand is being satisfied, not initiated. Rallies widen, progress slows, and volume expands without corresponding price gains. The professional is selling into strength, transferring risk to late buyers who believe patience alone guarantees profit. It must be understood that the extent of the effect is directly related to the magnitude of the cause. A long, well-formed accumulation produces a sustained and profitable advance. A brief and poorly constructed cause results in only a minor movement. The intelligent trader measures the cause by studying the time spent in preparation and the character of price and volume behavior within the range. He does not guess, he evaluates. Those who fail in speculation are often those who focus exclusively on effect. They chase advancing prices without understanding the groundwork beneath them, or they panic during declines without recognizing that the cause for the move was formed weeks or months earlier. By the time the effect is obvious, opportunity has already passed. The practical value of this law cannot be overstated. It teaches patience, selectivity, and discipline. It shifts the trader's attention away from prediction and toward preparation. The operator who aligns himself with cause places his trades in harmony with professional intent, not public emotion. In the end, the market is not mysterious. It is governed by laws as precise as any found in business or science. Those who study and respect these laws may not trade often, but when they do, they act with confidence, knowing that the effect they seek has already been earned through cause. In all my years of studying the market, I have found no single factor more revealing of professional intent than volume. Price alone may deceive, volume rarely does. Price tells us where the market has moved, but volume tells us how and why it moved. It is the force behind the movement, the visible expression of demand and supply in action. Those who ignore volume are operating with only half the evidence before them. Every advance or decline must be supported by effort. When price rises easily on expanding volume, demand is in control. When it advances on diminishing volume, the effort is lacking and the move is suspect. The public is inclined to applaud higher prices without questioning the power behind them. The trained operator asks a different question: who is doing the buying and at what cost? During periods of accumulation, volume performs its most subtle work. Activity often contracts, especially on reactions, indicating that selling pressure is being quietly absorbed. Occasional increases in volume on rallies suggest testing small advance, used by the composite operator to determine whether supply remains. These signs are easily overlooked because they lack drama, yet they are far more significant than the excitement of a runaway market. In markup, volume should expand in harmony with price. This is healthy action. Reactions occur on lighter volume, showing that sellers are reluctant and that supply is scarce. Here, volume confirms price and strengthens the operator's position. The trend continues not because of optimism, but because opposition has been removed. The most dangerous period for the uninformed trader is distribution. Price may still be advancing, sometimes reaching new highs, but volume tells a different story. Heavy trading accompanies rallies, yet progress is limited. Spreads widen, closes weaken, and supply meets demand at every advance. The public interprets this activity as strength. In reality, it is professional selling on a grand scale. The footprints are large, but only visible to those trained to see them. Volume also exposes false moves. A breakout on low volume is an invitation to disappointment. A decline on shrinking volume often marks the exhaustion of selling pressure, not the beginning of a collapse. The law of effort versus result is constantly at work. When effort increases and result diminishes, a change of trend is near. It must be emphasized that volume cannot be read mechanically. It must be interpreted in relation to price, time, and position within the broader structure. High volume at the wrong place has a very different meaning than high volume at the right place. Context is everything. The successful trader does not react to volume, he studies it. He observes how volume behaves at critical points, support, resistance, and turning areas. In doing so, he aligns himself with those who move markets rather than those who follow them. In the final analysis, volume is the market's confession. It reveals where large interests are active, where they withdraw, and where control shifts from strong hands to weak. Those who learn to read these signs step out of the crowd and into the company of professionals where speculation becomes a business, not a gamble. The public consistently underestimates the role of time in market operation. They believe opportunity appears suddenly and must be seized at once, confusing speed with skill. The composite operator holds a very different view. To him, time is not an enemy, but a weapon used deliberately to test, deceive, and ultimately transfer stock from weak hands to strong. Large interests cannot enter or exit positions in haste. Their size forbids it. To accumulate, they must allow time for supply to come to them. To distribute, they must allow time for demand to reveal itself. This necessity creates periods of apparent inactivity that frustrate the impatient and reward the disciplined. Sideways markets exist not because nothing is happening, but because something important is being prepared. During accumulation, time performs the essential task of wearing down sellers. Each rally that fails to follow through discourages the public. Each reaction that refuses to break support reduces fear. Volume contracts, price narrows, and interest fades. This is precisely the environment the composite operator desires. The longer this condition persists without breakdown, the stronger the underlying position becomes. In markup, time confirms the trend. Healthy advances allow for pauses and reactions, giving late sellers the opportunity to exit while denying them lower prices. The professional does not fear time in an advance, he welcomes it, for time tests the strength of demand. Weak trends collapse quickly. Strong trends endure. Distribution is where time becomes most deceptive. Price may continue upward, sometimes for weeks or months, while real progress diminishes. Each new high requires greater effort, and reactions grow deeper. Time here is used to convince the public that patience is virtue, and that holding longer guarantees reward. In truth, time is enabling the transfer of risk. The public waits, the composite operator sells. Time also exposes false moves. A genuine breakout holds its ground. A false one quickly retreats. The operator who understands this does not rush entries. He waits to see whether price can sustain its position. Time is the final judge of every market move. One of the gravest errors made by traders is the belief that more activity produces more profit. Constant observation leads to constant action, and constant action leads to loss. The composite operator acts rarely but decisively. He waits while others grow restless, knowing that impatience is the market's most reliable ally. It must be remembered that markets are designed to exploit human weakness. Time magnifies emotion, hope, and advances. fear in declines, boredom in ranges. Those who cannot withstand these pressures will surrender their positions prematurely or enter too late. The disciplined trader uses time to filter his decisions, acting only when the market has revealed its hand. In speculation, as in business, results are earned through preparation. Time is the medium through which that preparation becomes visible. Those who learn to respect it cease chasing opportunity and instead allow opportunity to come to them on terms that favor judgment over impulse. One of the most persistent illusions held by the public is that news creates market movement. In reality, news follows the market, it does not lead it. By the time a story becomes widely known, those interests capable of influencing price have already acted. The composite operator does not wait for confirmation from headlines, he positions himself in advance. The market, therefore, often reveals its true condition long before the reason is made public. This principle is most clearly observed at turning point. When unfavorable news fails to drive prices lower, it is not because the news lacks importance, but because selling pressure has already been exhausted. Supply has been absorbed quietly in advance. What appears to the public as resilience is in fact strength already in control. The trained observer recognizes this behavior as a signal to prepare, not to retreat. Conversely, when bullish news fails to produce higher prices, danger is present. At such times, demand has already been satisfied. Professional interests are distributing stock into public optimism. Volume expands, yet price progress diminishes. Each favorable announcement attracts new buyers, but price refuses to respond proportionately. This is not strength, it is weakness concealed by good news. The public reads news emotionally. Fear magnifies bad reports, greed amplifies good ones. The composite operator reads news diagnostically. He observes how the market reacts, not what the news says. The reaction is the truth. A market that refuses to fall on bad news is under accumulation. A market that refuses to rise on good news is under distribution. This inversion of cause and effect explains why the public is repeatedly caught on the wrong side of major moves. They sell in panic after prices have already declined substantially, and they buy in excitement after advances are well developed. In both cases, they are responding to information that is already discounted. It must be understood that large interests often require news as a tool. Favorable reports help stimulate demand during distribution. Unfavorable ones help create supply during accumulation. The news is not fabricated by the market, but it is certainly utilized by those who understand its psychological impact. For the operator, this principle demands independence of thought. He must detach himself from opinion and focus on behavior. Price, volume, and time provide evidence long before explanation arrives. Those who wait for clarity from news will always arrive late. The intelligent trader learns to ask a simple question: what is the market doing in the face of this information? If price and volume contradict the message, the market is revealing professional intent. This skill, once mastered, eliminates the need for prediction. In the final analysis, the market is a barometer of informed action. News merely supplies the narrative. Those who learn to read strength and weakness as they develop free themselves from the tyranny of headlines and place their confidence where it belongs, on the market itself. In speculation, survival precedes success. This truth is often overlooked by those who approach the market with ambition but without discipline. The market offers unlimited opportunity, yet it shows no mercy to those who expose themselves recklessly. The first duty of the trader is not to make money, but to protect capital. Without capital, judgment is rendered useless. The public is inclined to focus on profit alone. They seek the largest gain in the shortest time and measure success by occasional windfalls. The composite operator measures success by continuity. He understands that losses are inevitable, but ruin is optional. This distinction is the foundation of professional practice. Risk is controlled at the moment of entry, not after hope has replaced judgment. Every position must be taken with a clearly defined point at which the trade will be abandoned if proven wrong. This point is not chosen arbitrarily. It is determined by structure, by the level at which the market's behavior invalidates the original premise. When price violates that level, the operator exits without hesitation or regret. Position size is equally critical. A correct analysis poorly sized can still destroy an account. Large interests survive because they align size with risk, not with conviction. The public does the opposite. increasing exposure as confidence grows, often near the end of a move. The professional reduces risk as uncertainty increases and allows profits, not emotion, to dictate expansion. Risk control also governs patience. Not every opportunity deserves participation. Many losses are incurred not from bad analysis, but from unnecessary trades. The operator who waits for favorable conditions preserves both capital and mental clarity. He understands that standing aside is a position in itself. During adverse moves, the public hopes. The professional observes. Hope is the enemy of risk control because it replaces action with denial. The market does not respond to hope, explanation, or justification. It responds only to supply and demand. When evidence changes, the disciplined operator changes with it. It must be emphasized that risk control is not defensive in nature. It is enabling. By limiting loss, the operator remains free to act when genuine opportunity appears. Large profits are not made by avoiding risk entirely, but by accepting it selectively and intelligently. The law of averages favors the prepared, a method that produces modest gains while strictly limiting losses will, over time, outperform one that seeks occasional large wins at the cost of frequent damage. This is the quiet mathematics of survival. In the end, speculation is not a test of courage but of control. Those who master risk master themselves, and those who master themselves find that the market, while never generous, becomes fair, rewarding discipline with longevity, and longevity with opportunity. The principles set forth in this discourse are not theories, nor are they relics of a bygone era. They are observations drawn from the market's own behavior, tested across cycles, crises, and generations. Though methods, instruments, and speed have changed, the forces that govern price remain the same. Markets still move through preparation and execution. They still reveal intent. Through effort and result, they still reward patience and punish haste. The market is not an adversary to be conquered, nor a puzzle to be solved through prediction. It is a mechanism governed by law. Those who fail do so, not because the market is unfair, but because they refuse to study its language. They chase effects while ignoring causes, follow news instead of behavior, and expose capital without protection. The successful operator stands apart from the crowd. He waits while others react, observes while others speculate, and acts only when evidence aligns with opportunity. He understands that time, volume, and structure are not obstacles, but guides. He measures risk before reward and preserves capital as diligently as he seeks profit. These principles demand discipline, independence, and restraint, qualities rarely celebrated, yet always rewarded. They offer no excitement, no guarantees, and no shortcuts. What they offer is far more valuable: consistency, clarity, and survival. Those who adopt these laws do not trade more, they trade better. And in doing so, they align themselves not with opinion or hope, but with the enduring logic of the market itself, where success is not granted by chance, but earned through understanding.